Anita had already kind of alluded to the topic for today. Quick little disclaimer on everything. Of course, you should seek tax and legal advice for all this stuff, and I would encourage all the founders to really get good legal and accounting advice. It'll save you trouble down the road, even though it seems relatively expensive today, depending on what stage you're in and how much money or cash you have to do all of that. But I'd recommend getting very good advice. Take your time, get everything buttoned up and in order before you go raise a bunch of money and then have to clean it up and spend even more time and money in the future. So a little bit of background about me. I work for Holualoa Companies. I've been there about 10 years now. I'm the director of investments with Holualoa, and our primary business is commercial real estate. So pretty much all the food groups from multifamily to industrial, hotels, you name it. But we also run the family office for our founder out of the Holualoa offices and do early stage venture investments through that arm. So we've been doing that since before I got there, but for 10 years, I've been kind of looking at early stage investments. So how do we kind of figure out what structure you want, or people are asking for different times, can kind of change what's popular. The big picture is you can get a lot of the same features in different structures if you want. So they're all slightly different and have a little bit of upside and downside. But really, if you want to make sure that investors have certain rights, or that you have certain rights, or that something happens automatically in a few years, like conversions, all of that stuff can be done in different structures. And the big thing that I always usually hear from founders is they're worried that someone's going to take control, right, of their company, that they're going to be voted out, or the debt's going to take over, or something like that. And those are pretty rare scenarios, especially with early stage startups. It might be more common late stage, when the company's larger and they think maybe it needs a different type of CEO or anything. But really, if someone invests in your company, they want you to run it. And typically they don't have the expertise, time, or interest to run your company for you, or even put somebody else in that place. So really the best thing to do is just make the company a success, and then no one's going to care. So your first option that typically people hear about is what I'll just call like priced equity. So it's where you actually set a valuation for the company. And there's kind of two options for that. It's either common stock, which is usually what the founders own. And that basically never happens. You never raise stock at the same level as where the founders are. I mean, never say never, but it's very rare that you would just give the same stock to everybody. What typically happens is what's known as preferred stock. It sets the valuation for the company. You pick a dollar amount based on all sorts of things, size of the market, whatever traction you've got, comparable stuff, multiples that change, right? 6 months ago, you'd have gotten a much better multiple for your software company than now, after all the large tech companies have kind of taken a 50% plus kind of hit. You can have all sorts of investor protections and or voting, so we'll go through some of that in the next slide. But the downside is it can be a little more complex to negotiate and to set up. So that kind of depends on the size of the check investors are writing, for how much due diligence they're going to do, how many legal questions they're going to have, the back and forth of various, rights and things like that. I think if you can keep it pretty standard terms and don't make anything too unique to this investor, it'll be a lot easier to kind of keep your legal bills down, and also just keep things simple, which is usually a preference. So the pros on price equity, the nice thing is it actually just gives your company valuation, which can be good for both the investor and the company. Everybody knows what they have, when they're done with the investment. It also can set sort of the expectations for the next round, right? If you set the valuation now, that's kind of like your anchor for the next round based on whatever progress you make in between. And then for the investors, it gives whatever you think of as like the typical investor rights. There's some sort of liquidation preference, so that if the company sells, investors typically get their money back first, and then it splits to everybody else. There can be voting rights, there can be board seats, which can be beneficial or not. I mean, a lot of companies should have some sort of board. It's good housekeeping to have to report to investors and just keep yourself in that sort of rhythm. And then there's various information rights, investment rights like pro rata and dilution is something that investors will often ask for. They want to be able to invest more as you raise more, because as the company is a success, you want to put more money into it. Then the last one there on tag along and drag along is a little more so that if the founder goes to sell their shares, that investors get to sell their shares with the founder, right? The founder can't go sell control of the company to someone else and kind of leave the investors just hanging on. The big con is that it can be more time consuming than the other methods we're going to talk about. It doesn't have to be more time consuming, but if your investors are very just takes a lot of editing, they go over points 2-3 times, things like that, it can get more expensive. So you might in a lot of cases save this for a more established company or a larger round. So similar to that, you'll see convertible debt. So debt, it's a debt instrument, just like you think of a mortgage or anything like that. So it has to charge interest. You can't charge 0% or 1%. You'll get hit with different IRS potential liabilities because they'll say it's not actually debt and things like that. So it actually has to carry some amount of interest. It doesn't have to pay that interest currently, so it doesn't have to be a cash burn on the company. And typically with early companies, it won't pay that interest. It'll just kind of accrue. And then when they, say they invested $100,000 and you paid 8%, and then a year later when it converts, they just get a credit for $108,000. It's like a little extra. It's not usually a big deal on the cap table. Typically what they do is they'll convert into whatever your next round is at the equity price. So the assumption is that at some point, and usually in the near future, the next 24 months or so, you're going to raise equity and you're actually going to have a price round like we talked about before. So that's really what everybody wants to get to in the end. And what I have there for thinking about automatic conversion is that you don't want, one of the potential pitfalls of convertible debt is that it can be a cash crunch on the company if you don't reach whatever milestones you set for conversion before the maturity date. Because sometimes then the investors will want to be repaid, or you'll have to go ask them for an extension, or you'll have to ask them to convert it. And a lot of times investors will go along with it because, ostensibly, if you haven't hit your milestones and you haven't raised more money, it's not like you really have the cash to pay them back anyway. So likely, they'll extend it, but it's a headache for everybody. So sometimes I would think about doing automatic conversions where, if you haven't raised money and it hasn't hit whatever milestones were set, that it converts at some price and just kind of becomes a price round at that point. And then it gets the debt off your books. Something to consider. One nice thing, go back one, is that it can defer the pricing. And some people view that as a pretty good feature if they're just not sure exactly what to price their company at. But a lot of times you'll see investors ask for a cap on that pricing, because if investors are coming in early, they're taking more risk than whoever's going to come in 12 or 24 months from now. And you want to have not only a discount, but to make sure that if the company skyrockets right in the next 2 years and does fantastic, you want to be compensated for having been in there early when it was riskier. It's usually common for smaller rounds. You're raising without really like a large investor or a main investor, also known as a lead investor, who's going to be like your champion, doing all the due diligence, talking to other investors. It's not necessarily less dilutive. Sometimes people think of it as debt, and so they think it's not going to be as dilutive as the equity. But in any case, it usually ends up being equity, right? If anything's successful, it's going to end up being equity anyway. So make sure you understand when you go into it what that dilution is going to look like. So they're typically faster to set up because it's just a debt instrument. It doesn't have all the voting concerns. It doesn't typically come with a board seat. Until it becomes equity, it doesn't have all those kinds of terms to negotiate with investors. If investors are wary, they like a priced round, versus convertible debt. A lot of times what you can do is just put a cap on the conversion, which effectively makes it pretty close to the preferred equity we talked about before. The preferred equity gets paid, liquidation before common. The convertible debt would get paid in a downside scenario. But if you put a cap on it, that's essentially kind of pricing around, but it's a little bit softer of a price because it can still be a little bit dependent on the next round. Some of the cons and why some investors don't like convertible notes as much is that there's tax implications for investors about investing in equity versus debt that don't start until the conversion happens. So if you're looking at like a qualified small business stock and things like that, and then it doesn't always establish a price. And so investors can really be left up in the air that, who knows what I bought, how much I bought, what's the valuation. And that can, be on the company side too, not having a valuation set, without that anchor to go to the next round to establish, okay, we were 5 million and we achieved % growth. So maybe we're a $10 million company now. Without that anchor, your first valuation could just, could be higher, could be 15, could come in lower since you haven't said it before. They could say 7, who knows? And then the maturity, because it is a debt, just want to reiterate that one because I've seen that a lot, is that if you don't, get the progress you think you're going to get or raise that you are planning on, you want to have some mechanism to convert or extend or have some way that it's not a cash crunch on the company. And now safes, relatively new versus the other two, kind of came out of Y Combinator, very founder-friendly accelerator in Southern California. It's essentially an agreement for future equity. It's not actually equity. It's not debt. When they started, there was no maturity date. They would just potentially last forever and not ever become equity. It doesn't show up on the cap table. It doesn't show up on the balance sheet. They typically were used for fast, small companies, right? Idea stage, maybe slightly later than that. But the idea is that you just want to get in there, get your money in, give them a chance, see if it works. If it works, in 6 months, 12 months, they'll be raising actual, like a larger round and you'll convert later. So it would be a short-term kind of need. So they can function similar to the notes in that they convert into the next round. They can often have a discount to the next round. But unlike the notes, because they're not debt, they don't have any interest. It's used to be a big, just people would write it off. If you were trying to raise a safe, everyone would say no, at least outside of California. That's not so much the case anymore. You'll run into some investors where it's just a blanket no on safes, but not everyone. People are getting a little more comfortable with it as they've seen it, over multiple years now. So pros, similar to the convertible debt, it's even simpler than convertible debt. It's just fast. It's usually just a couple pages. The cons for investors is that there's no protections. It's kind of similar to common stock and perhaps potentially even worse in some edge cases, because the idea that it's going to become future equity if and when you raise another round, if your company is a gigantic success, right? It's possible, and you don't raise another round because you've just taken off, then the investors really have no way to actually get their investment in your company. They have an agreement for equity that might never happen. That hasn't really been figured out yet. And then similarly on the downside, if your company reaches a certain point and has value, but hits a wall and sells to someone else at a not a great exit, and you haven't converted it, do they have any rights to any of the money from the sale? I haven't really seen any of that come through yet, and I'm sure there will be some sort of legal case eventually, just to kind of figure that out. So the third point there, or second point, I guess, is really about avoiding. Sometimes you'll see stuff where people get a certain percentage of the company. rather than saying it's going to convert into the next round at some price. They'll say, okay, here's a safe for 5% of the company. The problem is you don't know what that 5% is going to be once the next round comes in. And if you just set a flat percentage, you'll end up giving away either more or the investor will get less than they were expecting. So a lot of it's just easier to set. If you're going to set like caps and prices like that for the next round, just pick a dollar amount rather than percentages. It can also be harder to keep track of, depending on if you can have multiple different safes with different people, unlike preferred rounds, where when you open up, say a $1 million preferred round, everybody gets the same preferred. Now, in most cases, everybody gets the same safe, but you really could write, 50 different safes for 50 different investors. It can be a little bit harder to keep track of, but that depends on how you kind of set it up. One part I'm interested to learn more about, and this is something to ask your CPAs, is how it impacts both a 409A and an 83B election. So 409As are, my understanding, is pricing your equity for when you do employee stock. So what's the value of it? What's the company worth for tax purposes? I don't know how safes are viewed since they're not debt and they're not equity. So I don't know where that really fits in that bucket. And similarly for 83B elections, when you get employee stock and options, you can choose to pay your taxes on it then when you get it, so that you then pay capital gains tax whenever you eventually sell it, rather than waiting and paying taxes on it, at the higher value later. Those are really questions I'd bring up with your CPA, just because I don't know how it fits into those buckets. So really, what's right for you, your company, whatever it is you're looking for. I think a lot of it depends on the stage you're at and what you're looking to get from your investors. Some people are looking to grow their board, or they want more investor advice and advisors, depending on who your investors are, if they have expertise in your area or have started similar companies before. In those cases, you'll probably go a little bit more towards the priced round, because those typically have the voting rights and the board seats that come along with it. If you want slightly easier documents and a little bit easier negotiations, because there's just less terms to negotiate, then notes and safes can be a little easier for you. Safes may turn off some investors. So depending on how many people you can have around the table that are interested in investing, you may need to be flexible between sort of like the safe and the note structure. And then what's your next milestones? How far away is it? How much money is it going to take to get there? And what does it mean for your valuation if you hit it? If you double your sales, does that double your valuation? Do you hit some point where now, okay, if you're below 10 million in sales, just getting to 10 million, kind of reach a threshold where now your valuation goes up twice, just because more people are looking at companies of that size. So if you're looking at something that's short term, that you think you just need, that little bit of extra capital infusion to reach that next point, you might be looking at notes and safes to get the deal done faster. And then, establishing an evaluation at some point, if you start with notes and safes, at some point you'll need the price round, because that's usually what makes them convert. So being familiar with price rounds, whether or not you go that route, immediately at the beginning, is still a good practice. And so again, a lot of people worry about control. I don't think any of these necessarily gives up control any more than the others. Having debt can be difficult, and if you have difficult investors and board seats and things like that, that's ideally you see that ahead of time and you don't get into that situation. But usually you still maintain control even if you have investors that are unhappy. So basically, get good legal advice. They see even more stuff than investors see, because they see every deal, right? I only see the deals that I do. So they'll not only help you kind of figure out which are the key terms, which are the ones to just let go and which are the hills you need to die on, and tell you kind of what's market in your area. Are you being friendly? Are you asking too much? they can kind of give you a good gauge on that of how aggressive you're being. And that's it. So happy to take anybody's questions and just give more detail as needed.
Thank you so much, Kevin. That was a fantastic overview. And yeah, if anybody has questions, we are putting them into the chat, please. So we'll get to them. But I'm going to start off with a really, probably, I hope people don't think I'm too stupid question, because I also heard the word warrants a lot when it comes about, investing and things. Can you just briefly touch on what a warrant is and how that fits into the scheme of things here, or not?
Sure. Yeah. So warrants are essentially, they're very similar to options. If anybody's familiar with stock options, the difference is options are on existing shares and warrants actually create new shares when they're exercised. But thinking about it, they're very much the same in practice. But it used to be that used to be more common with convertible notes, instead of offering a discount to the next round, they would give you some percentage of warrant coverage. So let's say you invested, $100,000 and there was 20% warrant coverage. You would basically get $120,000 you get $100,000 converted into the Series A, and then you get $20,000 of warrants of Series A stock. What people typically do now, you see warrants less and less, but it's kind of a 6 of one, half a dozen of the other scenario, is now my $100,000 just converts into the Series A at 80% of the price of the Series A. So it's similar in what they're trying to do economically. It's just a little bit easier to give a discount than to have a bunch of warrants. Then you got to keep track of, and then investors have to exercise later. It's just more paperwork.
All right, fantastic. Thank you so much for clarifying that. Mainly for me, I hope it's useful for others too. So there's a question here in the chat. If you're an early stage company and you have friends in California to do a safe with you, does that usually convert when you raise your Series A? If not, does it convert in most cases?
Yeah, I would say it'll usually do whatever your next round is. You can set up, a lot of times there's thresholds, right? If it has to be some meaningful round that protects investors from you just going raising $50,000 from your uncle and converting them at a terrible price. If you sets it up so it has to be $1 million or $2 million, whatever's the meaningful threshold for your company based on what you raised before and what your milestones are, it'll usually just go into the next round. Now, sometimes you could stack convertible things up until you eventually get a price round. You could do a safe, then you could do a convertible note, then you could do a price round. You could do multiple convertible notes. It can get complicated in there. You'll want to really make sure you keep track of how each one is going to convert in that sort of waterfall eventually when you do a price round.